Hey, so how's everyone doing out there? This is the third lesson from the third module, and this is all about estimating the future cash flows of a business. So, whenever I think about what probably one of the most important things that you're going to need to know how to do, this would probably be at the top of the list. And the reason why is because everything comes down to what the company's going to be able to do in the future, not necessarily what it's done in the past. And so, where this gets tricky is a lot of the times you're using information from the past in order to estimate what's going to happen in the future. And this really gets quite difficult to do and difficult to do well. So what I'm going to show you are a couple of the techniques that I personally use that I've learned from all these billionaire investors, specifically Warren Buffett, from what I've read. Just try to teach you some of the things and some of the pitfalls, I guess, as you're trying to make estimates into the future, because estimating the future is a very, very difficult thing to do, especially when you're dealing with businesses that are so complex with so much competition. And what you're going to see is a very conservative approach to doing this. So I want to start off by showing you an article that I wrote in Forbes about how I was determining what I thought Apple was worth back in September of 2016. When you scroll down through this article, what you're going to see is that I have a couple charts. And this first chart is the one that I want to direct your attention to. And what this is Apple's free cash flow over the last 10 years. And you can see that their free cash flow has just gone exponential almost. Now, this is a good thing, and then this can also be a bad thing because it might not be sustainable whenever it's growing so quickly. But what I did to kind of show you, so this is what's happened in the past. And then what I did is I created another chart, as you can see here, that estimates where that future cash flow might go into the future. And I basically created this small array where this top line is probably the best case scenario, and then the bottom line would maybe be the worst case scenario. Now, this is where I personally drew the line whenever I was doing this. A person is going to see this differently. Every person that's going to look at this is going to have a different opinion of what that array of future cash flows might look like. What's important is that you kind of use this framework and this thinking when you're thinking about this, because what a lot of people like to do is they like to just look at the past performance, which is our blue line here, and they would just say, oh, well, that's just going to keep on going into perpetuity. It's just going to keep on growing forever. And we all know that that's almost impossible and probably very unlikely. So when you're looking at this array of potential outcomes, you got to think in terms of probabilities. So what do you think the probability is that for the next 10 years, Apple's just going to continue to grow at kind of the rate that they've done in the past? I would say that that's a very low probability. Then you look at this line down here where their earnings, or not their earnings, but their free cash flow is going to start being flat. I would say there's a much higher probability that you're going to see it start leveling out more. And the truth is probably somewhere in the middle. So when we think about this and we're trying to estimate what the company's worth, picking one of these arrays or somewhere in this realm of possibility is what you're trying to do, because then what you're able to do with that free cash flow is then you're able to make an assessment of what the company's worth today, or what kind of yield the company can make today based on the current market price. So back whenever I wrote this article, Apple was trading at a price of $113 a share. And so I said back then that if you could buy this company for $113, which is what it was trading for on the market, this very point in time, I said that it might be worth around 11% annually if you could buy it at that price. So far, this has been a pretty good assessment because Apple's done extremely well. It's gone up at least $30 now in 2017 when I'm recording this. So far, it's panned out pretty well with respect to what I thought this company was way undervalued at this point in time. And whenever I did that assessment of 11%, I actually used this red line. I said, let's take the worst case scenario. Let's just say that Apple has a drastic change in its free cash flow, and it actually starts to go down slightly over the next 10 years. And so what I did is I used this red line and I illustrated, hey, if you buy it today, you're going to get 11% return. And that's if this red line comes true, not even the green line. So if you get the green line, you're probably definitely over 20% if something like that would happen. So this is a really important way to think about your businesses. You need to look at what's been their past performance and what do I kind of expect to happen in the future with respect to free cash flow. And that's the key thing, is the free cash flow. How much is this company able to bank after all their expenses are paid and the depreciation, amortization, all that kind of stuff? They're paying their CapEx. They're buying and adding on new assets and things. The money that's left, how can I value that money? And that's what we're talking about when we say value in the free cash flow. So what I did is I created a couple charts here. And these charts kind of give you an idea of exactly what I showed there. You got your free cash flow over on the left-hand side. You got time over here. And this line down the middle is everything that's happened in the past and then everything we expect to happen in the future. So let's take a company that's just had very level, very straight free cash flow in the past. Most likely, and now I'm going to get into some of the specifics of why this wouldn't be true, but most likely your array is going to be a little bit tighter because the company has a lot of stability and they're able to continue to bank this free cash flow. So I would draw, my personal opinion is I would draw a kind of a tighter array of outcomes from that point in time. Now, I'm going to get into the specifics on when you wouldn't do that. So let's go and let's talk through the three different scenarios. So then you have the other scenario where in the past, the free cash flow has been growing like crazy. This is the exact scenario that I described with Apple. You could say that a competitor now is going to take almost all of Apple's market share with respect to smartphones or whatever it might be. And then you might even draw this as being flat and then going down a lot because of the qualitative factors that are impacting the company. But most likely, in general, if you have a company that's growing a lot, I would say that you might even draw it kind of like the way I described here. Now, if a company's going down, it might go down a lot more. And so you might want to draw your arrays. And these are just generic arrays for not even a real company, just to kind of give you an idea of how to think through this. Most importantly, when you draw these arrays, you need to be thinking about the probabilities that are associated with them. So let's take this company right here. And let's say that this company just came out with a new asset that they just created that you think is going to be huge and that it's going to add a lot to their free cash flow. If that would be the scenario at this point in time, the array up here might actually have a higher probability than the lower array. So you might want to draw something maybe in here as your most likely free cash flow. It really comes down to mixing this quantitative factor where you're looking at the numbers and mixing that with your qualitative factors to really kind of get a great idea of, what that company's free cash flows will look like into the future. All right, so what I want to do is I want to show you an example where just using the quantitative numbers would probably get you in a lot of trouble. So what I mean by that is if you were looking at a chart and just looking at the last 10 years and you saw the numbers of the cash flow really kind of just going up and your expectation is something like that would continue or even be flat, I would argue that you're probably making a bad assumption and you also need to consider qualitative factors with your assessment of where that free cash flow might be going in the future. So the company that I have pulled up right now is Ford Motor Companies. And I have this on our new TIP Money site, and this is still the stage site, so we're still building this site at the time when we're recording this. But I pulled up Ford Motor Company, and when I'm looking at the company's net income, so this is the bottom line on the income statement. This is how it plots for the last 10 years of data when you look at it. So the net income's done pretty well, but let's look at the free cash flow. So I'm going to click on free cash flow. And if you're looking at the information over like the last 6-7 years, you could see that in 2009, the crash of 2009, Ford and every other car company just got crushed. Then what you see is graphically, you can see that their free cash flow has recovered a lot over the last 5 years, and it's actually starting to go up quite a bit. Now, where I would tell you that this is probably a very bad representation of what the company's able to do is because of macro considerations. So in 2017, we're at the a very, very high point on the stock market. You're seeing inventory levels on cars just shoot through the roof. Not just Ford, but GE and every other car company. Their inventory levels are just getting really, really high. And not only that, you're seeing a lot of people default on their first payment of their car, which was a really critical indicator before the 2008 crash that happened. And the other thing you got to understand about car companies is that they're very cyclical. So whenever the credit cycle starts to turn and starts to change, which is where I think we're kind of very close to happening here in the summer of 2017 when I'm recording this, that's going to have a major impact on how the free cash flow of a company like Ford is going to play out into the future. So if I was going to draw the plot that we have here for Ford Motor Company, and the ticker for Ford is F, in the past, the past 6-7 years, it's looked like this, just like on the other charts that we had. And this is where we're at today. This is time now. Whenever we think about where this is going to go into the future, I would say that your most probable array would be something like this, with this bottom line being the much more probable approach into the next 5 years. And then it's going to obviously have another recovery. It would probably go down like this, and then maybe have another recovery coming back up if we were going to do 10 years into the future. So whenever you would look at this might be something that you would be looking at for your free cash flows. And I know my chart here is really ugly, but the point and what I'm trying to make when you're trying to understand what these outcomes might look like, it's very, very rough and ugly when you're making these assessments because there's so many different probabilities that could occur. But this is the key point. You want to be conservative. You don't want to see a chart that's going sky high and say, well, I just think it's just going to keep on going and it's just going to keep going up. That's when you get yourself in trouble because you're not being realistic and you're not accounting for worst case scenarios. And this is the other thing. When you're making an assessment of what Ford's worth, when you're making an assessment of what GE might be worth, you want to kind of take a similar approach, because if you don't take a similar conservative approach to what you think the free cash flows are going to be, now you're adding a form of bias into the way that you're making these assessments of what the businesses are worth. And so now you're not comparing apples to apples with your assessments. You're biasing that in a way that isn't necessarily going to be good for you because you're not able to compare things equally. So this is a very, very tricky art. And as you can see, you've got to understand qualitative factors about the business. You got to understand qualitative factors about macro credit cycles. I think that's one of the biggest things that people don't understand is where am I at in the credit cycle and how's that going to impact the cash flows in the next 3 years, 5 years, 10 years moving forward. And when you make this assessment, you can draw this out and then you can take all the methods that Stig taught you in the previous module in order to do the math and figure out what the present value today is and what, associated yield you could expect by buying it at the present price. So this is really important stuff. I wish I could give you more information about estimating future cash flows, but to be honest with you, it really comes down to each company and it comes down to the underlying assets that company is going to have moving forward. So a real quick discussion about that. So whenever I look at a company's past performance and I see that it's really stable, I say, okay, well, which assets did the business own during this period of time? If I don't think that those assets are going to be impaired moving forward, like the Apple iPhone, if I think the Apple iPhone is going to continue to be a top selling product into the future, then that's something that will probably be representative with the way that the company is going to have free cash flow into the future. So you got to marry that up. You got to say, what was the free cash flow in the past? What was the asset that was producing that free cash flow? And what's my expectation that free cash flow can be attributed to the same or similar free cash flow into the future based on my expectation for competitors to erode that competitive advantage? That's how you're thinking through this. So it requires a lot of homework. It requires people to dig into 10Ks and 10Qs and really understand what's driving that free cash flow, like what's behind the free cash flow, and is it going to be sustained into the future? And if you can't say that it will, then you need to discount that and you need to make an estimate of free cash flow that's much lower than what it was in the past. So very tricky stuff, very difficult to do. But if you have the right framework to approach the problem and you understand this array that you're trying to build and the probabilities associated with the top of the array and the bottom of the array, that's going to be really, really important to your success making estimates of what a company's future free cash flows will be. So I want to leave you with two quotes that I'm going to read here for you from Warren Buffett from his shareholders meetings, where he talks a little bit about this estimate of future free cash flow how to approach this problem, because it is a problem. It's very difficult to do this, as I was explaining earlier. But this is some of the things that Buffett says about this exact topic. He says, some managers think that the value of their company is infinite and that it'll just keep on growing. He says, it gets very dangerous to assume high growth rates to infinity. That's where people get themselves into a lot of trouble. The idea of projecting extremely high growth rates for a long period of time has cost investors an awful lot of money. Go look at the top companies 50 years ago. How many of those companies have grown at 10% for a long period of time? And then those that have grown at 15 is very rarefied. And then he says, Charlie and I are rarely willing to project high growth rates. Maybe we're wrong sometimes, and that costs us, but we like to be very conservative. And so that's his first quote, and it goes totally into what we're talking about here with making these projections and these arrays of what you think the growth of the free cash flow might be. He's telling you, be very conservative. If you're using 10% growth rate, you're probably picking something that is highly unlikely, but maybe potentially could be in a very few instances. And if you're using 15%, he's kind of rolling his eyes like, yeah, you're making a bad assumption here on what the value of the business is going to be. The next thing that I want to read for you is another piece that kind of talks about intrinsic value and ties into this free cash flow estimates into the future. So Buffett said, intrinsic value is terribly important, but very fuzzy. We try to work with businesses where we have fairly high probability of knowing what the future will hold. And so then what he does is he gives an example of a pipeline that he had recently looked at. He had factored in that a competitor might come in, and he built that into the price that he had paid and the intrinsic value that he had calculated because he estimated much lower cash flows into the future because of a potential competitor. Lo and behold, that's what happened in the scenario that he was describing. He goes on to say, when we buy businesses, we try to look out and estimate the cash it will generate and compare it to the purchase price. We have to feel pretty good about our projections and then have a purchase price that makes sense. Over time, we've had more pleasant surprises than we would have expected, which is his way of saying every time that we kind of thought that something was going to do this, it was actually maybe a little bit worse, and it surprised them with how things actually turned out. I've never seen an investment banker's book in which future earnings are projected to go down, but many businesses' earnings do go down. We made this mistake with Dexter Shoes. It was earning $40 million pre-tax, and I projected this would continue, and I couldn't have been more wrong. So this was his way of saying when you're making that array of what you think the potential outcomes will be and the probabilities associated with those, don't rule out that the earnings could go down. And that's where we were trying to describe that with the way we draw things. A lot of the times I will just say, hey, in the future, I know it's been growing a lot, but I think it's just going to be flat, or I think it might go down by 5% every year, or what expected return we're going to get based on the current price. And then Buffett finishes his quote by saying, 20% of Fortune 500 companies will be earning significantly less in 5 years, but I just don't know which 20%. So that's important. When you're estimating and you're dealing with a Fortune 500 company, you're thinking, hey, this thing's huge. It can't have negative earnings or negative free cash flow growth into the future. Just remember, 20% of those businesses in the Fortune 500 are going to have a contracting free cash flow into the future. So something very important to think about, because that array of outcomes has a much higher probability to the downside than what I think people give it credit for. And so when you're making those estimates, always keep that in mind. All right, so that's all that we have for you on this segment. And I would challenge you to go out there and remember to marry up the quantitative with the qualitative. You got to do your homework, and you got to be conservative with these estimates that you're making into the future.